advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. My office is Asset Management Resources. We're a registered investment advisor firm. And our show is Something More, because we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters. Thanks for being with us. To join us today, I've got Jeff Perry as my co-host, and we are joined by Brian Regan, our Chief Investment Officer with Asset Management Resources. Thanks for being here, Brian.
Good to be here as usual, guys. How are you?
Very well. And Jeff, thanks for being here as well.
Always a pleasure. Thank you.
Well, you know, Brian, we had a few things to talk about that we wanted to discuss with you. Among them is an article you wrote recently, but maybe before we dive into the question of, you know, debt, good debt, bad debt, how to use debt intelligently, I thought maybe we could just touch base on this week's CPI numbers, which implied a little uptick, whatever the right term is there, for inflation, where we've been on a down slide for inflationary concerns. Was this expected, or is this something to be concerned about?
It's something to celebrate, actually. The devil's in the details as usual. And this came exactly in line with the market. So to answer your original question, was this expected? Yes, absolutely. Which is why the market and yields responded very favorably after the reading. Now, why is this an exceptionally, it's almost too low in a way. So 90% of the increase in inflation was caused from the shelter number. And it is generally accepted that, shelter is probably going to come down over the next few months as the lag data starts to come in. I'll just read this off to you straight from, the BLS website. The index for shelter was by far the largest contributor to the monthly all items increase, accounting for over 90% of the increase. So that's straight from the Bureau of Labor Statistics, if you don't want to take my word for it. So, overall, it was a very disinflationary number. And you could argue that, might be a little too low.
All right, so that's encouraging. Does that tell us does that give us any reason to think that the Fed is going to be thinking differently about how they, plan for what's to come when it comes to interest rate movements?
Well, I think the general consensus is if the Fed's not done hiking, they're very close. So I don't think that this changes that plan at all. If anything, it should give them pause about increasing again. At the same time, there was a unemployment new claims data that came out, and that was a little bit higher than expected as well. So that also gives the Fed, cover not to continue to raise rates. So, all these things are moving in the direction of a slower economy, but also lower inflation.
It's funny that we're kind of happy about a slower economy. You know what I mean? But at the same time, it's not so much, again.
Until you're not, right?
What's that?
So we'll all be happy until we're not, right?
Yeah, exactly. And at this point, it does not still seem as though we're.
Is anybody really ever happy with the economy? I mean, come on.
I guess I don't know. When it's booming, you seem like you should be happy, but we're all starting to get worried about inflation, I guess. But
I think we all like to worry, quite frankly. I know the commentators on the television shows and all the people who have an opinion want us to worry. It seems like, anyway. Brian, you're right. Just in the same week, we viewed a slower inflation number as positive, and we viewed a higher unemployment or potentially higher unemployment situation, both as good news. So good news is good news, bad news is good news, and we should all be worried.
Well, don't they say the market climbs a wall of worry?
Exactly.
Well, we talk all the time that the market is a function of earnings and interest rates, and the reality is that that denominator in the equation, which is the interest rate, is very, very powerful, right?
Right.
So you
Right.
need a pretty significant change in the top line to offset, a number that's much more stable on the bottom part. And I think what we're seeing is, earnings are expected in 2024 to increase 12.5%. I have no reason to think that's wrong, other than the fact that historically it tends to get revised a little bit. And we've been in a range of between 380 and 4 on the 10-year Treasury for a while now, and I think that's a function of inflation trending lower as it has since June of last year.
Well, and these are all important considerations as investors think about how to be positioning their portfolio, where to be, what to own, how to structure things. And so just it's an opportunity again to remind our listeners that if ever they need a little bit of assistance in that process, certainly reach out to Asset Management Resources. We've got a team of people who can be a resource to you, whether it's in thinking about economic issues that Brian's talking about, or the specifics of particular investments you own and whether they make sense in your portfolio right now in the environment we're in. Jeff, we often talk about, active allocation, and the asset allocation that is part of that is, one of the first and most important decisions is how much risk do we take? Do we have the right, mix recipe of, how much emphasis to put where?
Yeah,
And,
these things are very individual. We've been talking about the economy, which is kind of a general conversation, but when it comes to how your individual situation is and how you view the market, how you view risk, your time frame, your goals, these are all very individual things that deserve individual attention.
So if you need any help with any of that, certainly reach out to us at amrfinancial.com or give us a call 866-771-8901. I thought if we could, let's turn our attention to an article that Brian had written a little while back. Brian, where's this posted? It's on the street, or where is it now?
Yeah, it's on the street.com with Retirement Daily.
Retirement Daily.
I believe you can also find it on our website too.
So if you want to get a link to that or find it, you can go through our website, amrfinancial.com, where we have a variety of similar kinds of things, articles that have been posted. Tell us a little bit about your theory here, and maybe we could jump in. What was that you were saying?
I was just going to say the street does a really good job of cataloging everything I write for them. So you just put in Brian Regan, the street, in the Google, and you can see everything I've ever wrote, which is
nice.
Personally, I go there just to say, hey, what did I write, a year ago? I think it's kind of interesting to see what I was thinking a year ago. I'm sorry, Chris, can you repeat your question?
Let's do a little setup. So you did this article about using debt intelligently. And, I think Jeff and I will probably be the antagonist in this conversation for you, in that, one of the things that we often see is people use debt irresponsibly, and so it's a worry for us oftentimes that people take on debt in a way that can be detrimental to their financial well-being and long-term benefit. But your point, I think, and I want you just to elaborate, set it up, is that there are times when debt can be used intelligently and can be a good thing. So let's not necessarily always call it a bad thing.
Yeah, so I just think there's an enormous amount of information out there about how to pay down your debt, right? There's strategies that people have come up with, like the snowball, which, you pay off the first credit card with the highest interest rate, and then you pay off the next one. And then there's, psychological advice, like paying off the credit card with the lowest balance, so you start to feel good and feel energized. But I didn't feel like there was a lot of information out there for people who don't have a problem with credit card debt. I mean, I want to caveat this whole conversation that I think credit card debt's the devil. Get out of it as quickly as you can, and that's not what this article is about. But there's all sorts of ways that you can use debt intelligently to increase your net worth. And we just came out of a period where we had sustained low interest rates. You could buy things for 0% interest for a long time, right? So you could buy cars at 0% interest rate. You could buy furniture at 0% interest. You could buy, one of the strategies that I've utilized in my life is borrowing against a 401k, where you essentially pay yourself back interest. So it's, generally speaking, a 0% interest rate. And 0% is a very easy hurdle to jump over, right? So let's say that you finance some necessities in your life at 0% or a very low interest rate, and you take that cash, let's say over 5 years, and invest it in the long term in something like the stock market. The key is long term. The key is having some discipline. You at 10% per year average annual rate of return on the stock market, you're going to get, you're going to bank back about half the cost of that, furniture or car or whatever, right? It's a great way to give yourself a huge discount on these everyday necessities in life. I go on to say, I think I talk about mortgages a little bit, and Jeff, as a real estate, resident expert, I find real estate enormously beneficial. And when I read articles about how, you should rent instead of own, sure, sometimes that's best for you. But when you can leverage an asset at 10, 20 times at a very low interest rate, to the point where, if inflation rises by 2%, you're getting a 20% return on a 3% rate. That math is very easy to square. So, I just think there's a lot of areas in your life where you should look at.
What you mean by that math, because I think that wasn't clearly expressed. And what are you saying 20 times and that sort of thing?
Sure. So let's say that you were to buy a house for $1 million. I'm only using $1 million because it's a round number. I know it's an outrageously large price for a house. And let's say you put $100,000 down. Well, then you're leveraged 10 times, right? You only used $100,000 of your own cash. You borrowed
Gotcha.
900% of it. If your house increases with the rate of inflation, let's call it 2%, which is the Fed's target. Well, the value of your house is going to go up by $20,000, right? Which is a 20% return on your equity, which is, $20,000 on $100,000 is 20%.
Gotcha.
So, that's an enormously, interesting math problem right there.
Yeah, there's some cost to it as well. Maybe we got to back out, but I get your point. Ultimately,
not that much cost, right?
Yeah,
I mean, sure, there's cost, but that's one of the things that I think we're not fully appreciating. The problem with the cost is when you buy a house, it's an illiquid asset, right? You can't just pull out that 20 grand all willy nilly. So that's definitely something to consider. Which is the big, caveat at the end of my article is this is all well and good, but you need to make sure that you have the cash flow to make the debt service.
Jeff, before I go on, anything you want to comment?
Yeah, I think the premise, the math premise, there is two sides of this. It's a math issue, and then of course the other side is the behavioral issue and how you view debt, how you psychologically process debt. Can you sleep at night by having the debt? But on the math side, which I think is what Brian's focusing more on, the premise suggests that you're making a decision to, buy the car, buy the couch, or whatever you're buying with 0%. Therefore, it's a great deal because you can use the money. The premise is that you have the money, meaning the money is off to the side, and you have the ability to pay that debt off instantly because of your liquid assets.
Not only am I suggesting that it's off to the side, but it's invested.
Correct. So,
because otherwise, what's
the spread? Yeah,
it's really important not only for the math and the investing positives that you're talking about, Brian, but many of these people who say, "Oh, I can get a couch on 0%, I can get this car on 0%, I can finance this or that," are making these decisions because they think it's free money, which it is in a way, but it's still putting pressure on their cash flow. So if they actually are just having payments and don't have this cash to the side and making these decisions, which a lot of people make, they jump at these consumer decisions and don't have the asset to the side invested or in cash or in a high yield savings, and they lose their job, maybe they're self-employed and the business isn't performing, whatever the situation is, and they're not able to make these payments, they potentially setting themselves up for financial disaster.
And I completely agree with everything that you said, Jeff. I think that's separate but equal to my point, right?
Right. Yep.
That there's the emotional piece to investing, and then there's a very logical piece. I tend to focus on the logical, and as financial advisors, you guys tend to focus on the emotional, and that's good. They're both very important. But to anybody that's might be out there saying this is irresponsible advice to give to people, this is crazy. Most companies in the S&P 500, for example, do this, right? Kroger, I think I use as an example, they have a lot of debt. And what are they doing with that debt? Well, it's not just sitting there. They're investing in their business, and they're getting a higher return on their business than it costs for them to service their debt. I use the case of AutoZone, which has done fantastically well over the long term. More than 100% of their assets is financed with debt. JP Morgan, which is considered the stalwart of stalwarts of financial institutions in this country, they're a bank, so 90% of their assets are financed with debt. Whether it be deposits or otherwise. So this is something that's practiced and by business leaders around the world.
It's funny. We had planned this topic. You'd written this article a while ago, and we planned to do this topic. And this morning, as I was scrolling on Instagram, lo and behold, something comes up, and it's another advisor talking about good debt versus bad debt, which struck me as humorous.
Part of the trend,
yeah. And so the idea, I think we run into this question most frequently when people come in and say, should I pay off my mortgage? There's an emotional comfort in knowing that one is debt free, right? Particularly for retirees. And so, it often comes up that people say, should I pay off my mortgage? Now, if you have a mortgage from, 2 years ago and it's, 3%, maybe even below, or 3.5%, and there's a math equation that, I'm sure Brian would certainly argue for, right? The arithmetic. What am I getting for that money? I could park that money in a money market mutual fund and get 5%. And that's not even invested, really. That's just in cash, in a liquid investment. But if I actually put it to work in something that has the opportunity for appreciation as well, I could get even more, right? Maybe 10%. If it's costing me 3%, and that's not accounting for any tax benefit one might get as well, so there could be even less when you factor out a deduction one might get. But ultimately, and if I could get 7, 8, 9, 10, whatever I'm doing from that, how I'm investing, the level of risk I'm taking, there's an easy arithmetic that you can see the rationale for. Hey, this is debt that we want to retain because I can get a better rate of return by using that money and retaining that leverage, to get that spread, that extra return that is beneficial. Now, that's different from, as Jeff was talking about, there's oftentimes there's a head-heart decision. The head might say, hey, it's good math. And yet, oftentimes people will opt not to do the thing that is the best math just because it makes them more comfortable. And that doesn't make it a wrong decision. There's different priorities, different preferences. If your financial plan works either way, then it's just a matter of degree, right? How much benefit where you choose to prioritize. If your plan doesn't work so well, maybe the arithmetic becomes more relevant and more important. One of the things that we often have to worry about, though, is that people have a false sense of wealth when they use debt, when they have leverage. They have the impression that they own that. Let's just use the house again. They own that $1 million house. They forget that they have $900,000 of debt to offset that wealth. So in your scenario, Brian. So, it can create a false sense of security, and it's important that we keep that in mind, that we still have an asset that has a debt against it, so the net result is very different. Let's talk about current rates. In an environment where, what's a mortgage going for these days? Anybody know offhand? 7%?
Right, yep. A
Or
30-year is right around 7%.
Okay. So, how do you think about the math in that scenario, Brian? And I know Jeff or I will also comment on this, but it's kind of a different math equation to some extent. What do you think?
Well, if you're, you got to make some assumptions, right? The math problem is obviously not as attractive as it was, at 3% mortgages. But, if you're going to continue to assume that the price of your house is going to increase at 2%, well, 20% returns better than the 7% mortgage, right? So the math still works. Ultimately the math might not work because 7% mortgage means that the cash flow that you need to service that debt is much likely higher, at 7% than it is at 3%. So that should be a big part of your decision. If you can't make the payments, this doesn't work, right? So that's got to be number one. Kind of going back to what Jeff's concern was, right? But I think a lot of the times I think we're focused on retirees, as we should be, as a majority of our clients, the majority of the people that we serve are in retirement or near retirement. But if you're a younger person, say you're in your 20s or in your 30s or even in your 40s, and you still have working years for this foreseeable future, it can make a lot more sense to make these kind of judgments, right? To maybe lever up your own personal balance sheet.
I have to agree. The use of debt has been incredibly valuable in creating personal wealth, certainly with the mortgage and the house. Owning a house, home ownership, has been a hugely beneficial impact on my own personal financial well-being, growth of wealth over time.
There's basically no other asset that you can leverage 20 times at the age of 25, right?
In my case, starting a business, having the use of credit, and then obtaining a line of credit with the bank when we want it to grow and develop. These are resources that are very valuable. So I certainly concede that point.
What I think is kind of funny is I've had some reasonable pushback on this because people think it's almost irresponsible to say. But what I'm saying ultimately is just a math problem. It works. And the pushback is mostly, emotional, issues or discipline issues.
It's behavioral. I'd categorize them. I think the distinction, and both you gentlemen are drawing it very clearly, though, is we have to remember that when we just say using debt responsibly, what the types of debt we're talking about. Just a couple of days ago, the Fed came out with some record-breaking statistics. It seems like every month we're breaking these records, but total household debt, it reaches $17.6 trillion, and credit card debt has, for the first time, this is consumers, credit card debt has passed the $1 trillion mark. And I know, Brian, you're very clear about credit card debt is evil, and Chris, you're not suggesting it either, but I think people just hear the topic sometimes of using debt responsibly, and they don't go to the specifics that we're talking about here today about using debt, leverage, buying your home, somewhere you're going to live in, somewhere you're going to enjoy, raise your family, and a good investment.
Well,
and Chris talking about
huge risk. Right. When you have credit card debt, you can get into a hole that you can't get out of because the interest rates are so high. Even if you're trying to juggle 0%, eventually that 0% runs out. And you may not have the opportunity to switch cards the way you've been able to do. That can end up being, 18, 20% of an interest rate. And
not more, right?
You really cannot keep up with that at a sustained level at some point. Brian, you wanted to jump in, I can tell.
Well, credit card debt is so evil, right? Imagine if I told you there was a risk-free 20% asset out there. People would be so excited, right? That's what the bank's getting, right? Essentially, right? They're getting a not necessarily risk-free, but they're getting a 20% return on your credit card. And since it's an expense to you, it's a risk-free 20% return to pay off that debt. I don't personally think anybody should have any other investments until they've gotten a handle of their credit card, because there's no better investment than paying down that balance.
Right.
That being said, though, as part of using debt intelligently, there has been an instance that I've shared on the radio before where I used a credit card to invest in my education for the CFA. And I think that was an enormously good return on my investment. So, sometimes there can be, even good times to use that. It's just, what are you using it for?
In our studio, Kathy Ingersoll is with us, and she typed us a little note what about the idea of using a house, your primary residence, to leverage for the purchase of a rental property, perhaps can be useful in retirement or something like that, for some other goal. I got to say, I'd be hesitant to encourage people to do that, though certainly it's possible, right? The reason I'd be hesitant is I don't want the primary residence to be at risk of something going wrong with the rental property if you weren't able to get the rate of return. Or I've had clients get upside down on a purchase on rental properties that cause them to have to sell short on their property, and then ultimately their debt on their home is too high and so forth. You can run into issues where things can become problematic. So, but we see it often where people create a great deal of wealth by doing just that, where they borrow on one property to leverage to purchase another, create rental income that pays for the expense over time. The equity increases, whether it's because they're paying down the rent or, as Brian was pointing out, the increase in value. We've had a number of clients that have done enormously well in creating wealth with the use of property. Through 2007-8, right, problems. You're mindful of those issues as well.
You do hear about great success, especially on TikTok and some of the social media sites. You hear about all these ways to create wealth, and they seem very exciting. What you don't hear about is the failures. Where you hear about the failures of people who shouldn't have been landlords, improperly leveraged. If you want to hear about those, spend some time in bankruptcy court and see all the stories of the hundreds of thousands of people that go bankrupt every year because of misuse of credit and taking out too much risk and too much leverage. So, those stories don't make it onto the social media or the infomercials or selling books, but there's a risk involved. There's a risk involved.
To echo that point, and again, we're going to mention a little bit of caution here, even though Brian's article should be read. Please go take a look at it. There is a wise and intelligent use of leverage and debt. However, I'm going to end with a cautionary tale as well. We had a recent conversation with a family who's paying for their children's college education entirely by debt. They're not paying any of the tuition out of pocket. It's entirely with loans, and it's just not sustainable. They're not going to have the ability to continue to pay that cost and have any security in their financial future with at least the way they're currently spending money. These are things that we have. There are times it's challenging to talk about, and I'll use that as a setup because in a future conversation on the show, we're going to talk about what happens if your financial plan doesn't work. So join us for that on our next episode. So, Brian, great food for thought. It's entirely true.
Great article.
Be intelligent and take advantage of opportunities. At the same time, do it in a way that is responsible. Don't use debt just for frivolous purposes as well. Thanks for being with us.
Thank you, guys.
Okay, until next time, keep striving for something more.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.